Welcome to FAM Funds podcast series, where we speak with senior portfolio managers and investment professionals. Our goal is to provide investors with unique insights garnered from our bottom-up, in-depth research process. We hope this information is beneficial to you. Thank you for joining us.
Hello, I'm Ann Putnam, Senior Vice President and Head of Intermediaries at Fenimore. As second generation in our family business, I've experienced firsthand the relevance of bottom-up company analysis under my father's tutelage. Today, we want to share with you our definition of active management and how our mutual funds at FAM benefit from this approach. Joining me is John Fox, Chief Investment Officer and co-manager of the FAM Value Fund. John drives our active management process with a team of 7 overseeing 3 equity strategies. His experience dates now over 20 years with FAM, which provides us extensive portfolio management and bottom-up fundamental analysis on small and mid-cap securities. He's also been maintaining an intensive travel schedule this year, visiting company headquarters to conduct on-site due diligence. While John is joining us in the studio today without his guitar, we thank all of you for joining in and listening to our podcast. Good to see you, John.
Well, it's nice to be here.
If I may, I'll start with our first question. John, as you look at small, mid, or large cap stocks, active managers have been underperforming their benchmarks over various time periods, making the active versus passive debate relevant. Further, we've seen that trends in asset flows are suggesting that active investing is out of vogue because of the $854 billion of outflows since 2008. Why do you, from your perspective, think an investor should consider active investing?
Well, if you want to beat the market, the only way to do that is to have a fund that looks different than the market index. And the way to do that is an actively managed fund. I think a mistake that some investors make is they don't own funds that are actually active. There are many funds that are closet indexes, they own a lot of securities, and they really are not different from the market. So if you're going to own an active fund, make sure it's actively managed. I think a couple points on the studies of passive versus active. First one, all non-index funds are lumped in together. There's no differentiation for the expense levels, the number of securities that are owned, the turnover in the funds. So it's just all funds that are not indexes are lumped together. The second part is looking at risk-adjusted returns. People read the studies and see that the market has returned 10% and the fund did 9%, and they say, oh, it underperformed. But if the risk profile of the fund is less than the market, perhaps 9% was a good result. And so these studies are ignoring one of the laws of investing, which is the relationship between risk and return. So when you compare passive and active, you have to make sure the risk levels are similar.
Good point, which is why I believe our funds reflect the downside capture ratio of 70% versus the respective benchmarks, which notes the strong defense in bear markets. John, to your earlier points, FAM Funds exhibits high active share of 90+% and lower beta overall than the market, which showcases your active research and portfolio construction. In the fundamental analysis that you do, what is the most important piece of security selection, and how does this differ from a quantitative approach of other fund families?
Well, the most important things for us in security selection are, number one, that the company has strong financials. And by that we mean that they're profitable, they generate cash, the company has a strong balance sheet, and there are high returns on invested capital. Second thing we look for is management. We want managements that are skilled at allocating capital and exhibit honesty and integrity. And the third thing we look for is a price-to-value relationship. We value every stock that we own, and we're always comparing what we think the company is worth to the price in the marketplace.
So, John, if we could go back to one of your earlier points, let's explore risk-adjusted performance and the way in which FAM protects investors' capital, noting a strong Sharpe ratio comparison to their benchmarks. How does your investment process help manage risk, and why is it important?
Well, the 2 most important parts of the investment process to control risk are the things that we can control, which are the stocks that we own and the price that we pay for those stocks. And that's how we manage risk. And I'll talk about how that's helped over the last couple decades. If you think back to the collapse of the tech bubble, that was really a period of time of excessive valuations. And when those valuations came back to earth, many stocks declined 40, 50, or 60%. So the fact that we paid attention to prices and we paid attention to valuations helped us to avoid losses during that period. The more recent financial crisis showed if you owned poor quality businesses or over-levered companies, you could have a total loss in your investment So our focus on high-quality businesses with good balance sheets and cash flow helped us get through that period of time. So the combination of paying attention to valuations and the quality of businesses has provided good protection on the downside.
Given the current bull market and higher than normal valuations in this market rally, what is the status of valuations?
Well, you're right. This bull market has been running since the first quarter of 2009. And just to give you an idea, in March of 2009, stocks traded below 13 times earnings. If you look at the S&P 500 overall, there were $63 a share earnings, and the S&P 500 closed that quarter at about 800, so that's 12.7 times earnings. If you look at it currently, earnings have expanded to $116 a share, and the market trades just around 19 times earnings. So the multiple has expanded during the bull market. We would call valuations today fair to a little bit high. If you look at the multiple on the S&P 500 over the last 30 years, it's been about 17 to 18 times on average. So at 19 times, it's a little bit high. But of course, interest rates are very low, which can impact the multiple. So we think valuations are fair to a little high today.
And is that true also of the small and mid-cap space that we invest in?
Yeah, so using the Russell 2000 to represent small caps, that's actually a little bit more overvalued than the S&P 500. The long-term average for the Russell 2000 is about 17, 18 times earnings, and we're currently at 21 times, so small caps are a little bit more expensive.
And yet our portfolio reflects a concentrated account, which is different than the index you are citing.
That's right. We own fewer than 30 securities in our small cap fund, so it's quite different than the index.
John, given the recent election that's on everyone's mind today and the market reaction that has been favorable since November 9th, what are some of the potential impacts that you're seeing?
Well, we thought about the impacts in two categories, both positive and negative, or question marks. On the negative side, we have a new person in the White House, someone who's never held public office, and there's uncertainty about what he'll do. Second thing is, President-elect has talked about potential tariffs, and a trade war would not be good for the U.S. economy. And then with some of the growth initiatives in the economy that require borrowing by the government, there is a limit about how much the country can borrow. And so there's a question about the U.S. balance sheet, perhaps in the future. The positives, I think there are also three. The first one is potential for corporate tax reform. We could have lower corporate tax rates, which would make companies worth more. And you could have a tax holiday where companies that have money overseas could bring it back and invest it here in the U.S. There's potential for fewer regulations or less enforcement of regulations, which could be positive for industries like banking. And lower taxes and additional spending could increase the growth of the economy, which could be good for businesses of all sizes.
So, John, given the impacts of the election and how it might affect our strategies, are you doing anything differently as a result?
Yes, we are. On our financial stocks, we're evaluating the impact of higher interest rates, because with higher rates, our banks and insurance companies could be worth more. And for domestic companies that are paying full U.S. corporate tax rate, we're evaluating what they could be worth under lower tax rate scenarios.
So, John, one last question as it relates to the macro environment as well as the active philosophy at FAM. What is your outlook today for high-quality domestic equities?
Well, we think high-quality companies can continue to do well, and high-quality companies do well in good and bad environments. In a good economy, they grow like all other businesses and they become more valuable over time. But the key is in a poor economy or in a recession, they tend to hold up better due to the good profitability and the strong balance sheets. So we see in either type of environment, high-quality companies can do well.
And is there an example of that in any of the portfolios you'd like to speak to?
Sure, I'll talk about one of our large holdings in the Value Fund, Brown & Brown, which is an insurance agency headquartered in Daytona Beach, Florida. And Brown & Brown does well in a growing economy. They're an insurance agency, and so as companies are expanding, hiring employees, they sell more insurance and earn more revenue. But in a recession, it does very well because it has a strong balance sheet, generates lots of cash, and is very profitable. So the stock will typically do well in a bear market.
Thank you, John, for joining us today. Sorry that you weren't able to bring in your guitar.
Well, I can bring it in next time, and thanks for having me into the studio.
We appreciate that, and keep doing what you're doing back in Cobleskill. Happy holidays to all of you who are listening in.
Past performance is not indicative of future results. Current performance may be higher or lower than the performance data quoted. Investment returns may fluctuate. The value of your investment upon redemption may be more or less than the initial amount invested. To obtain additional prospectuses or summary prospectuses and performance data that is current to the most recent month end for each fund, please go to famfunds.com or call 800-932-3271. Please consider a fund's investment objectives, risks, charges, and expenses carefully before investing. The FAM Fund's prospectus or summary prospectuses contains this and other important information and should be read carefully before you invest or send money. The principal risks of investing in the fund are stock market risk. Stocks fluctuate in response to the activities of individual companies and to general stock market and economic conditions. Stock selection risk. Fenimore utilizes a value approach to stock selection, and there is risk that the stocks selected may not realize their intrinsic value, or their price may go down over time. And small cap risk. Prices of small cap companies can fluctuate more than the stocks of larger companies and may not correspond to changes in the stock market in general. FAM funds are distributed by Fenimore Securities Inc., member FINRA and SIPC.